Here's what most people don't see. MicroStrategy's perpetual strategy pivot isn't actually a strategy. It's a debt management technique disguised as visionary leadership. I'm James Whitman. For 12 years, I sat inside Fortune 500 boardrooms, not as a CEO, but as the consultant brought in when the numbers stopped making sense. I've reviewed 47 major corporate pivots. Most of them failed. And almost every failure followed the exact same pattern that I'm watching play out in real time at MSTR right now. Let me break down what's actually happening beneath the Bitcoin narrative. In May 2024, MicroStrategy issued convertible senior notes worth $1.75 billion. Then in August, they did it again, another $2.6 billion in convertible debt. Then in November, another $2.6 billion. That's $5.9 billion in new debt secured against Bitcoin collateral in less than 6 months. But here's what the market is missing, and why I want to walk you through the boardroom logic that's driving this cycle. MSTR didn't suddenly become a Bitcoin hedge fund. They became a company betting its solvency on a single asset class. When I worked with a Fortune 200 industrial company back in 2019, they faced a similar pivot moment. The CEO, let's call him David, had been running a traditional manufacturing operation. Margins were compressing. Wall Street was bored, so David pivoted. He started acquiring tech assets. He rebranded the narrative. Suddenly, every earnings call, every investor presentation, every board meeting centered on strategic transformation. Analysts loved it. The stock price climbed. But inside the boardroom, and I was in those meetings, the CFO kept raising his hand with the same question. How do we service the debt if the asset base doesn't deliver? David's answer: we extend, we refinance, we grow into it. That company declared bankruptcy 4 years later. Now let's talk about MSTR actual balance sheet, because the numbers matter more than the narrative. As of Q3 2024, MicroStrategy held approximately 226,500 Bitcoin on its balance sheet. That's not small. At $100,000 per Bitcoin, and Bitcoin has been volatile between $65,000 and $104,000 over the last 18 months. That's a notional value between $14.7 billion and $23. $5 billion sounds solid, right? Except collateral only counts when it doesn't move against you. Here's the trap. MSTR borrowed $5.9 billion at a blended interest rate of approximately 1% annually. That's roughly $300 million per year in debt service. Their core software business, which was supposed to be the foundation, generated about $660 million in revenue in 2023. But revenue isn't profit. Their operating margin in the software business hovers around 12-15%, which means actual operating profit is roughly $80-100 million annually. Now subtract $300 million in debt service against $80-100 million in operating profit. You see the problem immediately. MSTR is running an extension cycle. They're not operating a business anymore, they're operating a debt maturity schedule. Let me tell you what this looks like from inside a boardroom. When I reviewed the board composition at MSTR, there are 9 directors. That's above the S&P 500 average of 8, 4 directors. But here's where it matters. Of those 9, only 5 are classified as fully independent. The chairman, Michael Saylor, holds the CEO role, a governance structure that violates best practice at approximately 67% of Fortune 500 companies. When a CEO controls the board narrative, extension cycles get approved very quietly. I've worked with boards that faced similar situations. When Fortress Investment Group, a legitimate, well-managed company, had to refinance its leverage pyramid in 2009, they faced $4.2 billion in debt maturing over 3 years. But here's the difference. Fortress had an independent board that forced transparency. They had 11 directors with 73% independence. The CEO couldn't just message his way through the debt schedule. The board demanded cash flow sufficiency, asset quality, and stress testing. Fortress survived. The companies that didn't, Lehman Brothers, Countrywide Financial, AIG, they all had weak board oversight during refinancing cycles. MSTR extension cycle works like this. The debt comes due. Instead of paying it back from operations, they issue new debt. The new debt is marketed as strategic leverage to acquire more Bitcoin. The narrative shifts from software company to Bitcoin treasury company. Investors buy the story. Stock price stays elevated. Analysts upgrade. The CEO gets to talk about strategic vision on CNBC, but the underlying math doesn't change. The debt is still there. The maturity schedule is still tightening. In my experience, these cycles typically run for 3-5 years before they break. Sometimes the asset appreciates enough to cover the liability, in which case the CEO looks like a genius and everyone forgets how risky it was. But when the asset depreciates, or when the cost of borrowing spikes, the extension cycle becomes an extinction cycle. Let me give you a specific example. I reviewed Enron's refinancing strategy in preparation for a board training program in 2005. What struck me was how similar the messaging was to what I'm seeing at MSTR. Enron issued $3.9 billion in debt between 1998 and 2000, marketed as strategic positioning for deregulation opportunities. The board didn't push back because the CEO, Jeff Skilling, controlled the narrative. Every analyst report praised the visionary strategy. Then the asset base vanished, the extension cycle imploded. Shareholders lost $74 billion in market value. Now, I'm not saying MSTR is Enron, that's not a fair comparison. But the structural pattern, using asset appreciation narratives to justify debt issuance, controlling board messaging, extending maturities instead of paying them down, that pattern is identical. Here's what happens next. MSTR debt schedule shows significant maturities in 2027 and 2029. By my analysis, they'll need to refinance roughly $2.8 billion in 2027 and another $1 billion in 2029 for that refinancing to work. They need either A, Bitcoin to appreciate significantly enough that the collateral value supports higher debt levels, B, their core software business to generate enough cash flow to service debt without new issuance, or C, a full pivot to genuine Bitcoin treasury operations with sustainable funding. None of those are guaranteed, and if Bitcoin declines from current levels, or if interest rates remain elevated, the extension cycle breaks. When I've advised boards on leverage management, and this is the hard part that CEOs don't want to talk about publicly, the question isn't will our strategy work, the question is what happens if it doesn't. And the second question is who pays the cost. At MSTR, if the strategy works and Bitcoin appreciates, shareholders benefit and the CEO looks brilliant. If Bitcoin depreciates, the company faces forced asset sales, equity dilution, or refinancing at significantly higher costs. The employees and smaller shareholders pay the cost. That's not strategy. That's leverage masquerading as vision. The boardroom file here is simple. Pay attention to extension cycles. When a company keeps issuing new debt to service old debt, when the CEO controls the board narrative, when the underlying asset is volatile and external to the core business, that's not a pivot. That's a leverage trap dressed up in mission language. I've sat through hundreds of board meetings. The quiet ones, the boards with genuine oversight, with independent directors asking hard questions, with CFOs who aren't intimidated. Those companies survive downturns. The loud ones, the ones where the CEO controls the narrative and the board nods along, they're the ones that issue press releases about strategic pivots right before the maturities hit. Watch MSTR debt schedule. Watch their Bitcoin collateral valuations. And most importantly, watch whether the board actually pushes back on the next extension cycle. If they don't, you know something the market hasn't priced in yet. Subscribe if you want to see these boardroom patterns before the market does. We cover company strategy, CEO moves, hidden liabilities, and the moments where vision becomes liability. This